Picture two guys, same neighborhood, same kind of career. One retires at 60 with $2 million. The other keeps working until 65 and builds up $3 million. Which one is doing better? Most people would say the second guy, no question. More money is more money. But I've watched this play out enough times to tell you it's not that simple. The guy who retired at 60 is sitting on a beach in Portugal right now. The guy with $3 million is buried in tax paperwork, staring at a Medicare surcharge he didn't see coming, and quietly wondering why he worked those extra 5 years. He did everything right, and somehow ended up with less freedom. That's not a personal failure. That's a system problem. I used to tell clients to keep working until 65 for Medicare coverage. Made sense to me at the time. But when the tax law changes coming in 2026 started coming into focus, I realized that advice had quietly turned into a trap. Here is the trap. The financial industry built its entire retirement math around one target number. $3 million for $10,000 a month. Clean, simple, easy to sell. What that number doesn't tell you is where the money sits when you pull it out and how much of it you actually keep after taxes. Those three things matter more than the balance on the screen. And if you wait until 65 to retire, thinking you are buying safety, you may be buying the most expensive kind of safety there is. The trade-off is not about having more. It's about how much of what you have you actually get to use. If you want to stay ahead of what's coming in 2026 and protect the wealth you've spent decades building, hit subscribe. Now, let's talk about what $10,000 a month actually costs. Most retirement calculators give you a number, $2 million, $3 million. Hit that and you're done. What they don't show you is the tax layer sitting on top of every dollar you pull out. Say you want $10,000 a month to live on. That's $120,000 a year. Sounds straightforward. But if that money is sitting in a traditional 401k or a pre-tax IRA, you don't just take out $120,000. Every dollar that comes out gets counted as ordinary income and taxed before it hits your checking account. To actually spend $120,000, you need to pull out somewhere between $135,000 and $145,000. Maybe more, depending on your state. That gap, that extra $15,000 to $25,000 you have to withdraw just to cover taxes, is what I call the gross-up problem. It's invisible until you're living it, and that gap is about to get wider. The Tax Cuts and Jobs Act, which has been shaping your tax brackets since 2018, is set to expire on December 31st, 2025. Unless Congress acts, the rules reset automatically on January 1st, 2026. Here's what that means in plain numbers. The 12% bracket bumps up to 15%. The 22% bracket jumps to 25%. The 24% bracket climbs to 28%. And the standard deduction, which currently sits around $30,000 for married couples filing jointly, gets cut roughly in half. If you are planning to retire in the next few years and your money is sitting entirely in pre-tax accounts, you are looking at a higher tax bill on every dollar you withdraw, starting the moment those brackets reset. Pull $140,000 in 2025 and you might owe around $17,000 in federal tax. Pull the same $140,000 in 2026 under the new brackets, and that bill could climb to $23,000 or more. Same withdrawal, different year. Roughly $6,000 more gone. Over a 20 or 25-year retirement, that math compounds into something serious. Now compare that to someone who, before they retired, moved a portion of their savings into a regular brokerage account. Long-term capital gains in that account are taxed at 0% to 15% for most retirees, not at ordinary income rates. Their gross-up problem is much smaller. Their $120,000 net costs them a lot closer to $120,000 gross. The difference between a portfolio that is 100% pre-tax and one that is split, say 50% pre-tax and 50% in a brokerage account, isn't just a planning preference. It can be the difference between paying $300,000 in taxes over your retirement or paying $150,000. Where your money lives matters as much as how much you have. But income tax is only the first layer. Because if you thought working until 65 was the safe move, the next part of this is going to reframe that entirely. Let me introduce you to John. John is 65. He has $2,500,000 in his 401k. He spent the last decade as a senior director, pulling in $180,000 a year, and he kept his head down, maxed his contributions, did everything the right way. He feels safe. And by most measures, he should. But John is about to discover that the financial system has a very particular way of rewarding people who wait. First, the Medicare bill. John retired at 65, which means he is signing up for Medicare right on schedule. What he doesn't know yet is that Medicare doesn't look at what he's earning now. It looks back 2 years. His 2024 income, his last full year of peak salary, is exactly what the IRS uses to calculate his 2026 Medicare premiums. That rule is called the IRMAA lookback, income-related monthly adjustment amount. And for someone who earned $180,000 at 63 or 64, the surcharge is not small. Instead of paying the standard Medicare Part B premium of around $185 a month, John is looking at closer to $460 a month. For 2 people, that's over $5,000 extra per year, just for the privilege of having worked hard in his final years. He earned his way into a higher Medicare bill. That's the first surprise. The second one arrives at age 75. Required minimum distributions, or RMDs, are the IRS's way of saying, you deferred taxes long enough, now we collect. Starting at age 73 under current law, and potentially shifting under future rules, the government requires you to pull a calculated percentage out of your pre-tax accounts every single year, whether you need the money or not. For John, with $2,500,000 sitting in a 401k that has had another decade to grow, that RMD could be $130,000, $150,000, or more, landing on top of whatever Social Security he is collecting. Suddenly his taxable income is not $120,000. It's $220,000. He didn't choose to take that money out. He was required to. And here's where it compounds. That higher income triggers IRMAA again. It can push Medicare costs up further. It eats into the deductions available to him. It can even affect how much of his Social Security gets taxed. I've been close to situations where someone has worked an extra 5 years, done everything by the book, and then spent the first decade of retirement solving tax problems they didn't know they were building. The paperwork alone is a part-time job. There's also one more piece that catches high earners off guard. Under the Secure 2.0 Act, starting in 2026, anyone earning over $145,000 is required to direct their catch-up contributions into a Roth account. That's not optional. For people in their early 60s trying to push as much as possible into tax-deferred savings in their final working years, this changes the math on how much pre-tax runway they actually have left. The trade-off of working until 65 isn't more money. It's that instead of spending your 70s the way you planned, you spend them managing a tax problem you created by being disciplined in your 50s and 60s. That's the quiet cost no calculator shows you. And the reason most people don't see this coming is not because they weren't paying attention. It's because the anxiety of retirement creates a very specific kind of paralysis. One that even millionaires aren't immune to. You saved for 30 years. You drove the same car a little longer than you needed to. You skipped the upgrade, the vacation, the renovation. You maxed the 401k when your colleagues were spending their bonuses. You built something real. And now you are sitting in front of a brokerage account with 7 figures in it, and you cannot bring yourself to spend the money. Not because it isn't there, it is. But every time you think about pulling from it, something tightens in your chest. What if the market drops next month? What if I live longer than I planned? What if this is the year everything goes sideways? I've watched this happen to people with $2 million. I've watched it happen with $4 million. The number doesn't fix it. Because this isn't a math problem. It's a wiring problem. The same discipline that built the account is now working against you. Frugality is a tool. It's an extraordinary tool for accumulation. But retirement is not an accumulation problem. It's a distribution problem. And the habits that made you wealthy, if left unchecked, will quietly steal the years you were supposed to enjoy. There's a name for this: saver's paralysis. And it is more common among high net worth retirees than most financial content will ever admit. As a financial planner, my job is not to help you die with the largest possible balance. My job is to help you spend the money you spent decades earning. So how do you give yourself permission to actually use it? The answer isn't a mindset shift. It's a system. It's called the Guardrails strategy, and it works like this. Instead of locking yourself into a fixed withdrawal rate, say the traditional 4% rule, you set 2 boundaries: an upper guardrail and a lower guardrail. If your portfolio grows and crosses the upper boundary, the system gives you clearance to increase your spending by around 5% that year. You don't have to feel guilty about it. The math said yes. If the market pulls back and your portfolio dips toward the lower boundary, you make a modest, temporary adjustment. Something like trimming $400 to $500 a month for a season. Not a crisis. Not a collapse. A calibration. What this does is replace the endless internal negotiation. The should I, shouldn't I, is this okay, with a set of rules you agreed to in advance. The guardrails make the decision for you. You follow the system, not your anxiety. Think about what that actually means. You want to book a trip to Europe. Under the old mental model, you'd spend 3 weeks second-guessing it. Under the Guardrails system, you check the boundary. If the portfolio is above the upper line, you book the trip. Full stop. The cost of underspending is real. It doesn't show up on a tax return, but it shows up in the years you didn't travel when your knees still worked, in the dinners you skipped, in the experiences you told yourself you'd get to eventually. Eventually has a shorter window than most people account for. How many of you feel a tightness in your stomach every time you move money out of savings? Drop a comment below. You are not alone in this. So now we have the 2 pieces. We understand the tax trap that comes with waiting until 65. And we have a system that gives you permission to actually spend in retirement. Now let's put them together and run a real scenario. Let's run the real numbers, not a best-case scenario, not a pitch. A stress test. You are 60 years old. You have between $2 million and $2,600,000 saved. A mix of 401k, some Roth, and a taxable brokerage account you've been building on the side. You are tired. You are healthy. And you are seriously considering whether you actually need to keep working. The thing standing between you and that decision, more than anything else, is the gap. 5 years between 60 and 65, no Medicare yet, no Social Security yet, just your savings, and a health insurance bill that can run $1,000 to $2,000 a month for a couple on the private market. That gap feels scary. But it is also, if you have the right account structure, one of the most valuable tax windows of your financial life. Here's why. When you stop working at 60, your ordinary income drops to near zero. No salary. No W-2. If you draw primarily from your taxable brokerage account during these 5 years, the gains you realize are taxed as long-term capital gains, not ordinary income. For a married couple keeping their income under roughly $94,000 in 2025, the federal rate on those gains is 0%. Zero. You are funding your retirement by selling investments and paying no federal capital gains tax on them. That is not a loophole. That is the system working exactly as designed, but only if you are in a low-income year to use it. So during these gap years, you live on the brokerage account. You keep your taxable income low. And at the same time, you start quietly converting portions of your traditional 401k into a Roth IRA, filling up the 12% or 15% bracket each year, paying a modest tax now to eliminate a much larger tax later. By the time RMDs arrive at 73, your pre-tax balance is smaller. Your Roth is larger. Your Medicare surcharges are lower. The tax homework your future self has to do is a fraction of what John's looks like. Now, let's add the stress. It's your first year of retirement. You are 60, and the market drops 20%. This is the moment that breaks people who don't have a system. They see the number on the screen, they panic, and they either sell at the worst time or they freeze and stop spending entirely, which creates its own kind of damage. With the Guardrails system in place, here's what actually happens. Your portfolio crosses toward the lower boundary. The system signals a temporary adjustment. You reduce spending by roughly $500 a month. You postpone one trip. You don't touch the investment accounts more than planned. The portfolio is not in danger. It is operating inside the rules you set in advance. 1 year later, the market recovers. The guardrail resets. You book the trip you postponed. That is the entire difference between a retirement that works and one that doesn't. Not the market, not the returns. The structure you built before the storm arrived. A $2 million portfolio managed this way, with low-cost years in the gap, strategic Roth conversions, and a Guardrails spending framework, can outperform a $3 million portfolio that was never structured at all. The number on the screen is not the whole story. It never was. And if you want to make sure your structure is locked in before the 2026 tax changes hit, there are 3 specific moves you need to make now. None of what we've covered so far requires a financial genius to execute, but it does require you to move before the window closes. Because the 2026 tax reset is not a rumor. It is a scheduled event. And the people who will feel it the hardest are the ones who knew it was coming and assumed they had more time. Here are the 3 moves. Move 1. If you left a job at 55 or later, check whether the rule of 55 applies to you. Most people don't know this rule exists. If you separate from your employer in the calendar year you turn 55 or older, you can pull money from that employer's 401k without the standard 10% early withdrawal penalty. You still pay ordinary income tax on what you take out, but you avoid the penalty layer entirely. This matters if you are sitting on a large 401k from your most recent job and you are trying to fund the gap years without paying an extra 10% for the privilege. It does not apply to IRAs, and it only applies to the plan from the job you just left. But if it fits your situation, it is a meaningful piece of the structure. Move 2. Start Roth conversions now, before December 31st, 2025. This is the most time-sensitive move on the list. The gap years between 60 and 65, when your ordinary income is near zero, are the ideal window to convert portions of your traditional 401k or IRA into a Roth. You pay tax on the conversion at today's rates. Whatever you convert grows tax-free from that point forward, and it is never subject to RMDs. The math here is direct. Converting $50,000 a year at a 12% bracket costs you $6,000 in tax today. If you leave that same $50,000 in a pre-tax account and are forced to withdraw it at 73 in a 28% bracket under post-2026 rules, stacked on top of Social Security and other income, you pay $14,000 or more on the same dollars. Do that math over 10 or 15 years of conversions, and the difference between acting now and waiting can reach $200,000 to $300,000. That is the rescue number in the title of this section. It is not hypothetical. It is the gap between two versions of the same retirement. Move 3. Build your healthcare budget before you retire, not after. Private health insurance for a couple in their early 60s typically runs between $1,000 and $2,000 a month, depending on the plan, the state, and the coverage level. That range is real, and it is not going away. The mistake most people make is treating this cost as a reason to delay retirement. I'd encourage you to reframe it. That $1,000 to $2,000 a month is the price of buying back 5 years of your life before Medicare kicks in. Modeled correctly into your withdrawal plan, it is a manageable line item. Left unaccounted for, it becomes the reason you stayed at a job 2 years longer than you needed to. Budget it in. Know the number. Own it. The gap between paying 12% or 15% today on a Roth conversion and being forced into a 28% bracket at 73 with IRMAA surcharges on top is not a rounding error. It is the kind of difference that either funds a decade of travel or disappears quietly into a tax bill. The moves are not complicated. The window is. You spent 30 years climbing. Every contribution, every raise you didn't spend, every year you resisted the lifestyle creep, that was the climb. And it was hard, and you did it. But the descent is a different mountain entirely. Going up, the rules are simple. Save more. Spend less. Stay consistent. The math rewards patience and discipline almost unconditionally. Going down, the rules change. It is not about accumulation anymore. It is about sequencing, about tax brackets, about which account you pull from and when. The same habits that protected you on the way up can quietly work against you on the way down if you don't adjust. I've seen people reach the summit with more than they ever expected and then freeze. Not because they didn't have enough, because nobody told them the descent required a different set of skills. You have a choice in front of you. You can keep doing what you've always done. Stay cautious. Hold the number. Wait for certainty that never fully arrives. And spend your highest energy years building a tax problem for your 70s. Or you can use the math to give yourself permission. Structure the accounts. Run the conversions. Set the guardrails. And actually spend the money you earned. The 2026 tax changes are coming regardless of what you decide. The question is whether your retirement is structured to absorb them, or whether you will feel them on every withdrawal for the next 20 years. You did the hard part. The climb is behind you. If you want to make sure you don't take a wrong step on the way down, hit subscribe to We's Investor. This is exactly what we cover here. See you in the next one.